Usually when you talk about transitioning into a new technological age, there's this prevailing expectation of just clean, frictionless magic.
Right, yeah. Like it's all going to be easy.
Exactly. You think of sleek software or silent code or like
Yeah.
chatbots writing poetry in the cloud. I mean, we even call it the cloud, which implies this completely weightless, ethereal thing.
It's a very comforting illusion, honestly. We like to imagine the digital economy as something that just kind of floats entirely above the messy, unpredictable physical world.
Yeah, but then you step into the reality of what it actually takes to build that future, and suddenly that weightless cloud just crashes violently down to Earth.
It really does.
I was reviewing some of our research materials for today, and it hit me. We are looking at a technological revolution that is honestly covered in dirt.
Oh, absolutely. It is the absolute definition of heavy industry. I mean, when you pull back the curtain on artificial intelligence, you don't find magic.
Mhm.
You find millions of tons of concrete being poured. You find thousands of miles of subterranean fiber optic cables being laid down.
Right.
And you find these massive industrial cooling systems just gulping down fresh water and electricity on a scale we frankly haven't witnessed since the height of the Industrial Revolution.
And that collision between the frictionless promise of tomorrow and the incredibly heavy, expensive, and just messy reality of today is exactly why we're here. So welcome to the Deep Dive.
Glad to be here.
It is Monday, June 8th, 2026, and today's mission is designed specifically for you. We want to help you make sense of what has frankly been a whiplash-inducing weekend in the global markets.
Whiplash is definitely the right word for it.
For sure.
Yeah.
We're going to unpack why the era we used to call the Great Moderation, that comfortable, predictable economic blanket we've all been wrapped in for decades, is officially dead.
Completely dead.
And we'll explore what this new temperamental era actually means for your wallet, your long-term portfolio, and your everyday life.
And to do that, we are looking through a massive cross-section of data today. Instead of just staring at the daily ticker tape, we're pulling the underlying structural arguments from the comprehensive mid-year outlooks published by Charles Schwab and Keel Point.
Some really heavy hitters.
Exactly. And we're pairing those long-term views with real-time macroeconomic tracking from Yelza and trading economics.
Right.
While also filtering the weekend's chaotic price action through the lens of market wraps from Saxo Bank, Newsquawk, and Edward Jones.
It is a dense stack of intelligence, but we are going to extract the signal from the noise for you. Just to tease the wild dichotomy of the moment we find ourselves in right now, the stock market's historic 9-week winning streak was just shattered.
Brutally shattered.
Yeah, it was a brutal multi-asset sell-off. And the kicker, it was shattered by incredibly good economic news.
Which makes no sense to most people.
Right. Meanwhile, as we just hinted at, the AI revolution is quietly shifting away from, consumer software apps and plunging headfirst into physical infrastructure. And it's forcing the biggest tech companies on Earth to completely rewrite their survival strategies.
The overarching theme here is gravity. You've got financial gravity, physical gravity, geopolitical gravity.
Wow.
The market is waking up to the fact that you just cannot code your way out of real-world constraints.
Okay, so let's unpack this, because we really have to start with the immediate trigger for Friday's brutal sell-off. So
Yeah.
Friday was June 5th, and it delivered the U.S. May jobs report.
Right.
And the numbers were just staggering. Non-farm payrolls came in at 172,000 new jobs.
Which, requires some context to fully appreciate. The consensus forecast across the major institutions was hovering right around 85,000 to 90,000.
So it basically doubled expectations.
It literally doubled expectations, yeah. The actual print blew the doors off.
And it wasn't just a one-month anomaly, which is, what usually happens when the day gets weird.
Yeah.
They heavily revised the past months upward, too.
Right. April and March.
Yeah, April was revised up to 179,000 jobs, and March was bumped up by another 29,000. So if you smooth that out, we are looking at a rolling 3-month average of 188,000 jobs per month.
It's massive.
The headline unemployment rate held perfectly steady at 4.3%. And even the real unemployment rate, the U6, which captures discouraged workers and those working part-time for economic reasons, that dropped to 8.1%.
Which really paints a picture of an incredibly robust, highly resilient labor market. Employers are not just holding on to their workers. They are actively out there competing for new ones.
But here is where my brain starts to hurt. And I know a lot of people listening feel the exact same way.
I don't blame them.
Usually, more jobs, a low unemployment rate, people finding work that means we have a healthy, thriving economy.
You would think so.
That should be a cause for celebration on Wall Street. But instead, investors treated this hiring surge like it was a contagious disease. They punished the Nasdaq with a 4.18% drop on Friday.
It was ugly.
That is its worst single day since April 2025. The S&P 500 dropped 2.64%.
I mean, it feels like being grounded by your parents for getting an A+ on a math test. Why is the market throwing a tantrum over economic success?
To understand that paradox, you kind of have to separate the real economy from the financial economy, right? And then look at the bridge connecting them, which is the Federal Reserve.
Okay.
The market isn't reacting to the jobs themselves. It's reacting to what those jobs dictate about the future cost of capital. For the last several quarters, the market has been desperately clinging to this soft landing narrative.
That's the idea that inflation would quietly fade away, the economy would gently cool off without crashing, and borrowing costs would soon get cheaper.
Exactly. Investors were actively pricing in aggressive rate cuts. But this labor market strength, it completely detonates that narrative.
What? When you are adding 188,000 jobs a month on average, and that broader U6 rate is shrinking, it proves the economy isn't cooling down at all. It's running hot. It might even be accelerating.
Right.
And if you sit on the Federal Reserve Board, you look at this data and conclude that this economy does not require any artificial stimulation.
So wait, if the economy is doing great, why does a lack of stimulation cause a 4% drop in the Nasdaq? Like, if companies are hiring, shouldn't they be making more money?
That is true on the surface, but underneath, you have to look at the mechanics of valuation, especially for the tech sector. Tech companies, particularly those driving the Nasdaq, are valued largely on their future earnings.
Oh, okay.
When analysts calculate what a stock is worth today, they use what's called a discounted cash flow model. They take all the profits a company is expected to make, say, 10 years from now, and they discount them back to today's dollars using the current interest rate.
Ah, I see. So interest rates act like gravity on those future dollars.
A very heavy gravity, yes. If interest rates are near zero, a dollar earned in 2030 is worth almost a dollar today.
Makes sense.
But if interest rates stay high, say 5 or 6%, that future dollar gets discounted aggressively. It becomes worth significantly less today. So when the jobs report came out so hot, the market suddenly realized that the era of higher for longer interest rates is very real. The gravity just intensified.
And the data supports that fear, doesn't it?
Mm-hmm.
I mean, according to the CME FedWatch tool and the institutional estimates we pulled from Keelpoint, there is no longer a consensus for rate cuts at all.
None.
Instead, there is now a greater than 50% probability, with some models pegging it as high as 72%, that the Federal Reserve will actually hike rates by the end of 2026.
Yes.
That is a massive psychological and financial pivot from where we were just like 3 months ago.
It completely changes the math for every single participant in the global economy.
And for you listening, this isn't just Wall Street trivia. This translates directly to your life.
Yeah.
Higher borrowing costs impact absolutely everything.
Everything.
If you're looking to buy a house, those mortgage rates, which hovered around 6.48% for a 30-year fixed recently, they're going to stay elevated or climb even higher.
Yep.
If you're a business owner, your line of credit just got more expensive.
Yeah.
You don't have to be a tech CEO to feel the squeeze of a hawkish Federal Reserve.
No, you don't. And beyond the cost of borrowing, there is a secondary mechanism at play in that jobs report, which is wage growth. Average hourly earnings rose 3.4% year over year.
Okay.
Now, on an individual level, a larger paycheck is excellent news. But from a macroeconomic perspective, broad wage increases mean consumers possess more disposable income.
Right. And if they have more money, they're going to spend it. They're going to go out to eat, buy cars, book flights.
Which keeps aggregate demand extremely elevated. And when demand remains that strong, corporations face absolutely no pressure to lower their prices.
Oh, wow.
In fact, they can pass their own increased labor costs directly onto the consumer without losing any market share.
Which perfectly sets up the next domino to fall. If the economy is an overheating engine running on full employment and rising wages, we have to look at the exhaust.
Exactly.
And that means we have to talk about the return of the inflation monster. Because the data dropping this week is looking incredibly hostile.
The inflation data is the ultimate constraint on the Federal Reserve right now. We have the May U.S. Consumer Price Index, the CPI, dropping on Wednesday, June 10th.
Let me just share the forecasts from our Yelza and Trading Economics calendars, because they are not comforting.
No, they're not.
Headline inflation is expected to jump to 4.2% year over year. That is a significant acceleration from 3.8% in April. I mean, a reading over 4% would be the highest we've seen since April 2023.
Right.
Even core inflation, which, strips out the historically volatile food and energy sectors to give us a look at the underlying trend, that's expected to rise to 2.9%.
It is a really stark reminder that the last mile of fighting inflation is always the hardest. And we have to recognize this isn't isolated to the United States either. Across the Atlantic, the European Central Bank is poised to hike rates by 25 basis points this Thursday.
Let's clarify that jargon really quickly. So 25 basis points just means a quarter of 1%. So they're raising their benchmark rate by 0.25%.
Correct. And they are doing that because Eurozone inflation just hit 3.2% in May, which accelerated from 3.0% in April.
So we're seeing a synchronized global struggle.
Mm-hmm.
And if we look backward just a bit in the U.S., the personal spending deflator, which we know is the Fed's absolute favorite preferred measure of inflation that already spiked to 3.5% in the first quarter of this year.
Yep.
This is not a statistical blip. It's not a one-off weird month. It's a deeply entrenched trend.
It is a structural shift. And this is where we need to introduce a really profound concept from the Charles Schwab mid-year outlook. They argue that we are witnessing the definitive end of the Great Moderation and the birth of what they term the temperamental era.
The temperamental era. I love the branding, even if the reality of it kind of terrifies my portfolio.
Yeah, it's a great name.
But let's take a step back. Before we explain the temperamental era, we need to understand what we just lost. So walk us through the Great Moderation. What was that environment actually like for an investor over the last, 30 or 40 years?
So the Great Moderation broadly refers to the period from the mid-1980s up until the pandemic. It was characterized by two massive, multi-decade tailwinds.
Yeah.
First, globalization rapidly expanded, which meant corporations could outsource manufacturing to cheaper labor markets. That kept consumer prices incredibly low.
Right.
Second, because inflation was consistently trending downward, central banks were able to steadily lower interest rates.
Mm-hmm.
We went from interest rates in the double digits in the early 80s down to effectively zero in the 2010s.
So for almost 40 years, money just kept getting cheaper and cheaper.
Exactly, and that environment forgave a multitude of investing mistakes. It was an era where a rising macroeconomic tide lifted virtually all boats. You could throw a dart at a board of stocks, buy bonds, or invest in real estate, and the sheer force of falling interest rates would likely make you look like a genius over a 10-year horizon.
But the Schwab report is saying that tailwind is gone. We're now in the temperamental era. So what are the rules of this new game?
Well, the temperamental era is defined by structurally higher economic growth colliding with highly volatile inflation.
Okay.
Globalization is fracturing into regionalism and protectionism. Labor is demanding higher wages. The cost of raw materials is fluctuating wildly. In this regime, inflation isn't a solved problem. It is a persistent, recurring threat.
Okay, let's test that logic. How does that practically change the way someone should build a portfolio? Because the Schwab report noted that in this new era, stocks and bonds are increasingly moving together in a positive correlation.
They are.
If stocks and bonds are dropping at the exact same time, which is exactly what we saw on Friday, with the S&P 500 tanking, while the 10-year Treasury yield shot up over 4.5%, then the traditional 60-40 portfolio strategy is fundamentally broken.
That is the core danger, yes.
I picture the 60-40 portfolio like jumping out of a plane. Your stocks are the main parachute, right? Meant to catch the wind and lift you up.
Right.
And your bonds are the reserve parachute, meant to save you if the main one fails.
Right.
But in the temperamental era, it seems like both parachutes are tangled together. When one fails, the other one drags you down with it. Why are they suddenly tangling?
You're hitting on the absolute core friction there. To understand why they tangle, you have to look at what the market is actually afraid of.
Okay.
During the Great Moderation, the primary fear was usually a growth shock, like a recession. If a recession hit, stocks would fall because corporate profits would drop. But bonds would rally because investors knew the central bank would cut interest rates to stimulate the economy, making existing bonds more valuable. So they moved in opposite directions. They hedged each other perfectly.
But today, the fear isn't a recession. The fear is inflation.
Precisely. When inflation is the primary driver of market anxiety, the mechanics completely invert. If a hot economic report comes out, like we saw on Friday, it implies higher inflation.
Right.
Higher inflation hurts bonds because it means the central bank won't cut rates, so bond yields spike and their prices fall. Simultaneously, it hurts stocks because higher interest rates increase borrowing costs, and compress those future valuation models we discussed earlier.
So inflation is the gravity that pulls both the stock market and the bond market down at the exact same time. The safety net is just full of holes.
Yes, exactly.
So where do you hide? If the index funds and the bond aggregators are all bleeding, what is the strategy?
The strategy must pivot from passive reliance to deliberate, active diversification. You can no longer just buy a broad index and assume the macroeconomic tide will do the heavy lifting. You have to seek out companies with incredibly high earnings quality.
Break that down. Define earnings quality in this context.
It means a company isn't relying on cheap debt to stay alive. It means they have a fortress-like balance sheet. It means they generate massive free cash flow internally.
Right.
And most importantly, it means they have true pricing power, the ability to raise the prices of their goods or services without losing their customers. You are no longer betting on the ocean's current. You have to bet on the structural integrity of the strongest individual ships.
And navigating those ships is getting incredibly treacherous right now. Because while domestic wage growth is certainly a major factor in this sticky 4.2% inflation forecast, it isn't the whole story.
Far from it.
There is a massive, highly unpredictable driver of these costs happening entirely outside of domestic borders. So we have to pivot and talk about the shipping lanes of the Middle East and the geopolitical whiplash we just witnessed over the weekend.
Geopolitics has re-entered the economic equation in a way we really haven't seen since the 1970s energy crises. It is currently injecting a massive risk premium directly into the global energy grid.
Let's trace the timeline of this weekend's chaos based on the market reps from Newsquawk and Saxo Bank, because it felt like watching a tennis match played at fast forward.
Oh, it really did.
Early on, we saw the ongoing conflict between Israel and Iran threaten the Strait of Hormuz. For those who aren't logistics nerds, the Strait of Hormuz is arguably the most critical global choke point for crude oil.
Absolutely.
Predictably, when that region destabilizes, oil prices spike. We saw West Texas Intermediate, or WTI, hit $95.25 a barrel. Brent crude reached an alarming $98.08.
Those are pain thresholds. When crude oil flirts with $100 a barrel, it acts as a massive tax on global economic growth.
And then the weekend updates just became a blur. Israel struck targets in Beirut. Iran retaliated with 4 waves of strikes against Israel, officially closing its western airspace.
It was incredibly tense.
The escalation seemed inevitable. But then, out of nowhere, U.S. President Donald Trump intervened, claiming on social media that immediate ceasefire negotiations were proceeding and that things would move quickly. Subsequently, Iran actually announced a halt to military operations, warning they would only resume if provoked. And Israel, reportedly at the U.S.'s request, halted its direct strikes on Iran, though they did continue operations in Lebanon.
The speed of that de-escalation announcement caught algorithmic traders completely off guard.
It really did. WTI crude moderated, settling back down to around $90.88 by Monday morning, and Brent closed near $94.
Yeah.
But here is the piece of the puzzle that doesn't fit. I need you to explain this to me. Okay. The political leaders are claiming peace is imminent. The shooting, at least directly between the major players, has ostensibly paused. Yet oil is still up nearly 60% year-to-date. If the crisis is averted, why didn't oil immediately drop back down to, like, $70? Is the market just calling their bluff?
I see where you're going with that, but look at the mechanism of physical trade. The market isn't necessarily calling their bluff on the ceasefire. The market is pricing in the reality of the physical supply chain. This is what commodity analysts call an embedded geopolitical risk premium.
Break that down. What does that actually look like in the real world?
Okay, imagine you are the CEO of a major maritime shipping company on Sunday night. You have a massive oil tanker sitting in the Arabian Sea. You hear about the ceasefire on social media. Do you immediately order your captain to sail straight through a recently active war zone?
Absolutely not. I'm waiting for verification. I'm waiting to see if it actually holds.
Exactly. And more importantly, your insurance underwriter isn't going to just instantly drop your premiums back to peacetime levels because of a political announcement.
Oh, that makes sense.
The damage to the logistics networks is already done. Rerouting ships around the Cape of Good Hope adds weeks to delivery times and millions of dollars in fuel costs. Major oil companies are warning that because of these delays and reroutes, we could see physical shortages of crude oil at refineries within weeks, not months.
Because you can't just flip a switch and instantly normalize massive, slow-moving physical infrastructure. The supply chain has severe PTSD.
That is a very accurate way to frame it. And it's not just crude oil either. We saw European natural gas, specifically the Dutch TTF benchmark, which is essentially the price setter for natural gas in Europe, spike over 3% to roughly 50 euros per megawatt hour.
Why does Europe care so much about a spike in June? Isn't winter, like, months away?
Because right now is when Europe is supposed to be rebuilding its liquefied natural gas inventories ahead of the winter. They buy gas in the summer to store it.
Oh, I see.
If those shipping flows from the Middle East are disrupted now, Europe faces a massive, catastrophic energy deficit when the weather actually turns cold.
Which brings us back to the inflation monster and why this matters so deeply to you, the listener. If oil stubbornly stays above $90 a barrel because of this embedded risk premium, that cost bleeds into the price of literally everything you touch.
Every single thing.
It increases the cost of the plastic components in your phone, the diesel fuel for the trucks delivering your groceries, the fertilizer used to grow your food.
This creates a classic cost-push inflation scenario. And this is the ultimate nightmare scenario for a central bank.
Wait, what is the difference between cost push and what we normally experience?
Normally, we experience demand pull inflation. That happens when consumers have too much money and chase too few goods.
Right.
The Federal Reserve can fix demand pull inflation by raising interest rates, which cools down consumer spending. But cost push inflation happens when the actual supply of critical goods is restricted. The Federal Reserve can hike interest rates to 6%, 7%, or even 10%. But a rate hike does not reopen the Strait of Hormuz.
Right.
A rate hike doesn't extinguish a fire on an oil tanker.
It's a blunt financial instrument trying to solve a physical logistical crisis.
Exactly. The Fed can crush domestic demand by making borrowing incredibly expensive, but if the supply of energy is artificially constrained by war and insurance premiums, prices at the pump will stay high anyway.
Wow.
This is how an economy slips into stagflation, stagnant economic growth, combined with high inflation. Consumers face crushing prices regardless of whether the broader economy is booming or busting.
It is a terrifying prospect. The tools we rely on to fix the economy literally cannot reach the root of the problem. But, while geopolitical conflicts are squeezing the traditional energy grid, there is an entirely different, uniquely modern technological force that is gulping down electricity at a staggering rate.
Yes, there is.
And this is where we pivot from the oil fields of the Middle East to the server farms of Silicon Valley. We need to talk about the AI infrastructure megacycle.
This is perhaps the most profound structural shift happening in the global economy today, and it is largely misunderstood by the general public.
Let me hit you with a statistic from the UN that absolutely floored me when I read it in our notes. Global data center power demand is now equivalent to the energy consumption of the 6th largest country on Earth.
It's unbelievable.
Let that sink in.
Yeah.
The servers running our artificial intelligence models are collectively consuming more electricity than major industrialized nations. And their water footprint, millions of gallons of fresh water, required strictly to cool these massive server farms down so they don't melt, matches the total water needs of sub-Saharan Africa.
What is fascinating here is the total fundamental shift in the artificial intelligence narrative.
Wow.
For the past 2 years, the market has been obsessed with the software layer.
Right, the fun stuff.
Exactly. We were all captivated by the consumer-facing magic tricks. We were marveling at chatbots writing poetry, generating photorealistic images, passing the bar exam, and writing code.
It felt like living in the future. It felt frictionless.
But the magic trick phase is over. The market has moved past the novelty, and now it is looking at the bill. We are moving rapidly out of the software phase and into the heavy industrial phase of AI.
Okay.
This is no longer about writing clever algorithms. This is about physical infrastructure. It requires custom silicon, advanced packaging facilities, massive industrial cooling systems, and millions of miles of fiber optics to connect it all.
It sounds like we are done marveling at the idea of the gold rush, and we are finally looking at the massive concrete and power bills required to actually extract the gold. If I look at the stock market right now, we aren't investing in the prospectors anymore. We're investing in the companies selling the pickaxes and laying the railroad tracks.
That is the perfect mental model. And this shift toward the heavy industrial reality of AI is exactly what triggered Friday's secondary market plunge within the tech sector. Broadcom, which is a massive player in semiconductor and infrastructure software, missed the sky-high expectations for their AI chip sales.
Why did one company missing expectations cause such a massive ripple effect, though?
Because the market has priced these infrastructure companies for absolute perfection. Investors have assigned them valuations that assume flawless exponential growth for the next decade.
Oh, I see.
When a company is priced for perfection, any slight miss, any hint of a delay in the supply chain triggers a violent re-rating downward.
But the heavy industrial machine didn't stay down for long, did it? Because Monday saw an incredible rebound, and it was driven by massive, almost unfathomable corporate capital expenditure.
Yeah, the numbers are wild.
Alphabet, Google's parent company, announced an $80 billion equity issuance. And here's the crazy part. $10 billion of that came straight from Warren Buffett's Berkshire Hathaway. They are raising $80 billion solely to fund AI capital expenditures, building the data centers and buying the chips.
That is a staggering sum of money. To put that in perspective, hyperscaler capital expenditure, the money being spent by the giants like Google, Amazon, Microsoft, and Meta to build out these physical data centers is so massive that it is single-handedly acting as a global macroeconomic stimulus.
Wait, real?
Yes. The sheer volume of their spending is propping up economic activity and offsetting weakness in traditional manufacturing sectors.
And the money is flowing into very specific physical channels. Intel shares skyrocketed 10% on Monday. Why? Because Google just ordered 3 million custom tensor processing units, or TPUs, directly from Intel's foundry business for delivery in 2028.
Right.
And there are credible reports that NVIDIA, the undisputed king of AI chips right now, is evaluating Intel's 18A manufacturing process, which is their advanced 1.8 nanometer node, to start building their next generation of processors.
This is a major turnaround story for Intel. They've spent years trying to establish themselves as a viable contract manufacturer to compete with TSMC in Taiwan.
Yep.
But more broadly, it highlights the physical bottleneck of AI. It does not matter how brilliant your software is or how elegant your neural network is if you do not have the physical silicon to run it.
Right. And it's not just the chips. It's the nervous system connecting them. Corning, the glass and ceramics maker, just scored a multi-billion-dollar deal to lay fiber optics specifically for Amazon's data centers. It is a literal infrastructure boom. But as an investor looking at this objectively, this brings us back to the danger zone.
Yes, it does. We have to discuss concentration risk.
Right. The Schwab Outlook pointed out that a massive disproportionate percentage of S&P 500 earnings growth relies solely on this AI infrastructure spending.
If you look at the distribution of earnings growth in the market today, it is historically narrow. A tiny subset of companies, mostly in the semiconductor and digital platform space, are carrying the entire market on their shoulders.
Right.
The other 490 companies in the S&P 500 are largely just treading water.
Let me push back on this, or at least play devil's advocate for the listener. If Google is spending $80 billion and Amazon is buying billions in fiber optics, aren't we building a massive bridge to nowhere if these models don't actually monetize? Like, if Google spends $80 billion on data centers but can't figure out how to make consumers or enterprise clients pay enough for Gemini to justify the cost, doesn't the floor fall out?
That is exactly the high-stakes dependency risk.
Yeah.
The entire stock market has virtually zero margin for error right now. Valuations are priced for a future where AI fundamentally revolutionizes productivity across every sector of the economy, from healthcare to finance to logistics.
Right.
If that timeline is delayed by even a year, or if the physical constraints we discussed, like running out of electricity or fresh water, halt the data center build-out, the valuation reset will be severe.
So the market is essentially holding its breath, hoping the physical world can sustain the demands of the digital world. And this massive pivot toward acknowledging the physical and financial limits of AI, this realization that you have to partner up to survive the heavy industrial phase because you can't afford to build it all yourself, is perfectly encapsulated by what is happening over at Apple.
Absolutely.
Because Monday, June 8th, was also the start of Apple's Worldwide Developers Conference, WWDC.
And this wasn't just any routine product update. This was a historic changing of the guard at one of the most important companies in human history.
Absolutely. This was Tim Cook's final keynote address.
After leading the company since 2011, taking over from Steve Jobs, and guiding Apple through a massive, highly profitable transition into the services era with Apple Music, Apple TV, and iCloud, Cook is officially stepping down as CEO on September 1st, 2026.
End of an era.
He is transitioning to executive chairman, and he will be succeeded by John Turnus, who is currently the senior vice president of hardware engineering, which, as a strategic signal to the market, is profound. Promoting the head of hardware engineering to CEO signals that Apple intends to secure its legacy as a physical hardware innovator first and foremost. They are a device company.
But while the future CEO is a hardware guy, the presentation itself was entirely obsessed with software, specifically artificial intelligence.
Right.
Apple officially introduced Siri AI, and this is where my jaw dropped when reading the transcripts. Siri AI is notably powered by Google's Gemini models. The keynote script mentioned Siri 102 times. To put that in perspective, their traditional operating systems, iOS and macOS, were mentioned in the single digits. It was entirely the AI show.
It represents a monumental shift in Apple's corporate strategy.
Wait, let me push back hard on this because I am struggling to understand the logic. Apple is the undisputed king of the walled garden. They control the silicon chip, they control the phone hardware, they control the software, they control the app store. They are fiercely, almost ruthlessly protective of their closed-off ecosystem. And yet, they are outsourcing the actual brain of their flagship virtual assistant to Google's Gemini. Yeah. Isn't this a massive failure of Apple's R&D? They have effectively unlimited cash. Admitting they can't build a foundational AI model to rival Google feels like a huge strategic defeat, not just a partnership.
I understand why it looks like a defeat, but you have to view it through the lens of the physics and economics we were just discussing. The sheer compute power, the real estate for data centers, and the tens of billions of dollars in capital expenditure required to train and run top-tier foundation models are astronomical.
Okay, fair.
Even Apple, one of the richest companies on Earth, recognizes it is vastly more efficient to partner than to build it entirely from scratch.
So you're saying they looked at the $80 billion Google is spending on servers and decided let them foot the bill.
Precisely. They are making a deeply pragmatic choice. Apple realizes they cannot outspend Google or Microsoft on server farms without destroying their own world-class profit margins. So they will own the hardware interface, the iPhone, the Vision Pro, the Mac, and they will let Google burn the capital on the heavy industrial compute side.
But how does that work with privacy? Apple's whole brand is built on not harvesting your data, which is the exact opposite of Google's business model.
It comes down to API handoffs and privacy walls. Apple is likely running smaller, highly optimized AI models directly on the device for basic tasks, reading your calendar, sorting your photos.
Okay, that makes sense.
But when you ask a complex, compute-heavy question, Apple anonymizes the request and hands it off to Google's Gemini servers via an API. Google processes the answer and sends it back, but Google never gets access to the user's underlying identity or personal data profile. Apple acts as the privacy shield.
It makes sense financially, but it's still a shock to the historical Apple ethos. Now, speaking of the Apple interface, they did roll out some proprietary features that don't rely on Google. They introduced new, dedicated child accounts for users under 13 with incredibly detailed, age-tailored safeguards.
Which is a big deal.
Huge. Parents can now manage contact lists across FaceTime and Messages, set discrete screen time allowances for specific types of apps, and there's a new real-time automatic image filtering system that flags adult content or violence, even during live FaceTime calls.
It is a strong, necessary move toward platform safety, which is increasingly becoming a regulatory focal point worldwide. But speaking of regulation, the global rollout of Siri AI hit a massive geopolitical roadblock that perfectly illustrates our earlier themes.
Ah, yes. The temperamental era strikes again. Due to strict compliance requirements under the European Union's Digital Markets Act, the DMA Apple announced that Siri AI will be delayed in Europe. It will not be available on iOS 27 for European users initially, though it will roll out on Macs and Apple Watches.
This is a perfect, tangible illustration for our listeners of how geopolitical fragmentation impacts daily life. When we talk about the temperamental era, it's easy to dismiss it as high-level macroeconomic theory, or assume it's just about oil tankers in the Middle East. But it directly affects the technology you hold in your hand.
It completely fractures the digital world.
Exactly. Protectionist policies and localized digital regulations mean that the internet and the tech ecosystem are no longer truly global. What features you can access on your phone, what AI models you can use, and how your data is processed now depend entirely on the regulatory regime of the physical country you reside in.
And just to briefly touch on how these corporate realignments are happening entirely outside of the tech bubble, we are seeing defensive sectors consolidate to survive this high inflation, highly fractured environment.
Right.
Ingredient just bought Tate & Lyle for $3.6 billion in an all-cash takeover to create a massive global ingredients powerhouse.
It is a classic defensive maneuver. When input costs, like the agricultural commodities and energy required for production, are rising due to inflation and supply chain shocks, companies consolidate to find cost synergies, reduce overhead, and protect their profit margins.
So let's look at the board. We have tech valuations resetting due to high interest rates, inflation forecasts rising to 4.2%, corporate giants joining forces to weather the storm, and geopolitical conflict threatening the energy grid. In a world this chaotic, you would expect investors to be flocking to the traditional safe havens of the financial world.
You really would.
You would expect them to be buying digital gold and physical gold, but they aren't. And that brings us to the bizarre behavior of the ripple effects across alternative assets.
The price action in the alternative asset space over the last few days has been incredibly revealing about the true state of global liquidity.
Let's look at the data, starting with crypto. We tracked the fallout across digital assets, and it was an absolute bloodbath on Friday. Bitcoin plunged below that crucial psychological level of $60,000. According to Glassnode data cited in the Schwab report, the market suffered $1.2 billion a day in realized losses. There was massive forced deleveraging in the futures markets.
Walk through what forced deleveraging actually means for a retail trader because it explains the severity of the drop.
Right, so imagine a trader on a Sunday night. They have $10,000 of their own money, but they borrow another $40,000 from the exchange to take a highly leveraged $50,000 bet that Bitcoin is going up.
Okay.
If Bitcoin drops by just 20%, their entire original $10,000 equity is wiped out. The exchange won't risk losing its own money, so it automatically issues a margin call and forcefully liquidates or sells the trader's position at the market price.
And when thousands of these leverage positions are forcefully sold at the exact same time, it creates a cascade. Selling triggers more price drops, which triggers more liquidations, which triggers more selling.
Exactly. Now, Bitcoin did rebound to roughly $63,600 by Monday, and that was aided heavily by corporate buying. MicroStrategy stepped in and bought another 1,550 Bitcoin. But the crypto winter chill was definitely in the air.
For sure.
But the asset that really broke my brain this weekend was gold. Gold broke key technical support levels at $4,360. It fell below its 200-day moving average for the first time since October 2023. And it did this even while the People's Bank of China continued buying massive amounts of gold for their sovereign reserves for the 19th consecutive month.
It's counterintuitive.
I am genuinely baffled by this. If the world is so chaotic right now, we literally have wars threatening global shipping, inflation spiking, tech stocks selling off violently. Why did gold, the ultimate financial panic room, actually drop? That feels completely backward to everything we were taught about finance. If the world is ending, shouldn't gold be going to the moon?
It is a brilliant observation, and it highlights a fundamental misunderstanding many people have about how safe havens actually operate in the modern financial system. This raises an important question about the sheer gravitational pull of the US dollar and Treasury yields.
Okay, walk me through it. Why did the panic room fail?
Remember what triggered Friday's sell-off? The massive jobs report, which means the Federal Reserve is likely going to keep interest rates higher for longer. As a result of that expectation, the US dollar index, the DXY, surged to 100.02, and the 10-year US Treasury bond yield climbed over 4.5%.
Okay.
Now, put yourself in the shoes of a massive institutional investor or a sovereign wealth fund. You are terrified of inflation. You are terrified of geopolitics in the Middle East. You want a safe place to park $1 billion.
Right.
You look at gold. Gold is shiny, it has historical precedent, and it holds its value over centuries. But crucially, it yields absolutely nothing. It does not pay a quarterly dividend. It does not pay monthly interest. In fact, it costs you money to safely store it in a vault, and it costs you money to insure it.
All right, it just sits there looking pretty while you pay armed guards to watch it.
Exactly. Now look at the 10-year U.S. Treasury bond. It is backed by the full faith and credit of the United States government, which, despite our intense political gridlock, remains the most secure, liquid guarantor in the global financial system.
Yeah.
And right now, because the Fed is keeping rates high, that bond is paying you a guaranteed risk-free return of over 4.5% every single year.
So when the risk-free rate is that high, it acts like a black hole for capital.
Precisely. When investors can get 4.5% completely risk-free, the opportunity cost of holding a non-yielding asset like gold becomes mathematically unbearable. Capital flows out of gold and into the US dollar and treasuries. It doesn't matter how anxious the world is or how many bombs are dropping, the mathematical gravity of a 4.5% risk-free yield will crush the appeal of gold.
And I imagine that exact same higher for longer gravity is what's crushing the speculative leverage in the crypto markets. If money is expensive to borrow, if your baseline cost of capital is 5%, you can't afford to take wild, highly leveraged bets on Bitcoin futures. You need a much higher return just to break even on the interest you are paying.
The era of free money is definitively over. During the 2010s, when interest rates were at zero, capital was desperate for any kind of return, so it flooded out into the furthest reaches of the risk curve into speculative assets, unprofitable tech startups, and crypto.
Right.
Now that cash itself generates a reliable 4.5% return sitting in a money market account, the hurdle rate for taking a risk on Bitcoin or high-growth tech stocks is significantly higher. The bar has been raised.
That brings everything full circle beautifully. Let's synthesize this deep dive so you, the listener, can take these macroeconomic insights and apply them to your own financial life. What we are seeing across every single data point, from the 172,000 jobs to the $80 billion in AI spending to the drop in gold, is that the global economy has officially crossed the Rubicon into a new structural regime. The Great Moderation, that cozy 40-year era of low inflation, falling interest rates, and predictable growth driven by globalization, is dead. We have entered the temperamental era.
And the rules of survival in this era are vastly different. Rate hikes by the Federal Reserve are a real looming threat again because the labor market is running incredibly hot.
Yep.
Inflation is sticky, driven by resilient consumers and structural energy shocks. Geopolitics is no longer just something you watch on the evening news. It is directly pricing the fuel in your car and dictating what artificial intelligence technology you can legally access on your smartphone.
Furthermore, the artificial intelligence boom, which has almost single-handedly carried the stock market for the past 2 years, has matured. We're out of the cute software phase and into the brutally expensive, heavy industrial infrastructure phase. AI is now a game of concrete, copper, fiber optics, and massive energy consumption.
Therefore, the mandate for the listener is incredibly clear. You must critically evaluate concentration risk in your portfolio. You cannot blindly trust that a rising macroeconomic tide will lift all your investments because that tide is gone.
Right.
You must actively seek out companies with true earnings quality, fortress-like balance sheets, and real pricing power. And above all, you must prepare mentally and financially for a volatile, temperamental market where the traditional 60-40 safety net may no longer catch you when you fall.
It is a lot to process. The world is getting heavier and the math is getting harder. But understanding these structural shifts gives you an incredible edge over the investor who is just reacting emotionally to daily headlines.
Absolutely.
But before we go, I want to leave you with one final lingering idea to ponder on your own. We drew this directly from the logic of our sources today, but it takes us one step further into the future.
Oh, this is a good one.
We noted earlier that the UN reported AI data centers now consume power equivalent to the 6th largest country on Earth, and freshwater equivalent to sub-Saharan Africa. We also talked extensively about the temperamental era being defined by protectionism, fractured supply chains, and geopolitical conflict like the EU blocking Apple's AI or the Middle East threatening global energy flows.
Right.
So ask yourself this. What happens when this unstoppable technological force of AI meets the immovable object of energy nationalism?
And it is a chilling intersection to consider.
If physical resources, electricity grids, fresh water for cooling, land for server farms run incredibly tight, what is the next logical step for a sovereign nation? Will we see countries embargoing electricity?
It's possible.
Will a government look at a multinational tech giant and say, in the name of national security, we are shutting off the power to your massive AI data center because our citizens actually need that electricity to heat their homes this winter?
That's a very real scenario.
The next major global conflict might not be fought over oil fields in the Middle East or territorial borders in Eastern Europe. The next true geopolitical war might be fought over the physical grid capacity required to run artificial intelligence.
Oh, when the ethereal cloud requires the physical Earth to survive, the Earth will inevitably dictate the terms.
Keep questioning the consensus. Keep looking at the physical reality hiding behind the digital promises. And thank you so much for joining us on this deep dive. We will see you next time.